Welcome to Straight Talk for Entrepreneurs, where we reveal what it really takes to build a successful business. Whether you are starting with an idea or growing your business, this is the show for you. My guests and I will show you how to build a strong mindset, a powerful body, a profitable business. Hi, I'm Brandon C. White, and this is Build a Business Success Secrets. Hey, everybody, and welcome to another episode of Build Your Business with Brandon. We've got J.J. Childers, a attorney who sets up corporations and knows all the structures that you should have. JJ and I know each other from speaking at entrepreneur events over the last few years, and I've always loved his talks. In fact, even having 20 years of experience myself, I always learn something from JJ, so it's awesome. Thank you so much for being here today.
Hey, thanks for having me, Brandon. I appreciate it.
Yeah, so today I'd love to give a little bit of background how you got started doing this and your attorney career, and then move into so that we can cover for everybody, because I know this is a question you get all the time. It's a question that I get over and over and over again, which is what type of company I should have. So we can cover a C Corp, an S Corp, sole proprietorship, limited partnerships, and LLCs. I think I got them all there.
You got it.
So why don't we jump in, and how did you get started doing this type of work for business owners?
Well, it's kind of interesting, Brandon. I grew up down in Orlando, Florida, and my dad was and is an active real estate investor and developer. He got his start down there in Orlando, and he was active in that. He was developing automotive strip centers. He was president of his local real estate investment club. And then that kind of got him into actually teaching at real estate seminars throughout the country. And growing up around that, I was just actively involved in the real estate, but also in the seminars. And even when I was in college, I was studying business for my undergrad. I got a Bachelor of Business Administration. I thought, I probably wanted to get involved in real estate maybe. And I really enjoyed the teaching aspect of it and being involved in not only doing, but then teaching people what we were doing. And I thought, this may be what I want to do with my life. And coming out of college, I was 22 years old, and I thought, who's going to listen to me? I'm 22 years old. I said, if I was a lawyer, they'd probably listen to me. And I thought, that was something that I have always kind of thought I'd like to do anyway. And then I said, and then if the whole speaking and seminar thing didn't work out, then, now you're just a lawyer. There are worse things.
Yeah, that's true.
I kind of looked at it and I said, this is what I'm going to do. And what made that especially interesting was that knowing while I was going through law school what I actually wanted to teach helped me choose my elective courses. Obviously, you've got certain courses that you've got to take that are your required courses and the things that you're going to be covering on the bar exam. But then a lot of the electives I took were things that were more applicable based on what I knew already from working with my dad, things that he wanted to know about taxes and different types of debtor creditor law, making sure bankruptcy, which sounds weird that we would say bankruptcy, but bankruptcy is one of the key areas for asset protection, which is part of what we're going to be talking about here today. So I want to make sure that people understand that bankruptcy, when most people think about it, they think of it as a negative. And I look at it and I say, yeah, but there's some very powerful strategies that you can learn through bankruptcy law that can be very beneficial for you with your asset protection, because you've got to take a look at what you can protect, what's not protected. So then that helps you in your planning process. So I kind of did that and then went to law school and ended up, taking estate planning courses and things along those lines to make sure that I had the requisite background. While I was in law school, I worked for the Attorney General's office because I wanted to understand that. I did an internship clerking for a federal judge, so I wanted to see that aspect of it. I worked for a plaintiff's law firm for quite a while because I wanted to see what is it that they're looking for when they're going after assets. So I wanted to see what's the other side looking at. And then I also worked in the state legislature. I was the reading clerk during law school there, so I saw how laws were made. So I got a very well-rounded experience, not only going to law school, but also through my jobs that I had during law school, which kind of got me uniquely qualified and prepared for the career as an asset protection attorney.
Yeah, well, I love that. I love that you know all the positions of the job. And I think that's one of the things that makes you unique in that sense, that you have that. And I think that's something that I've tried to do myself. And I know how valuable it is, especially having been on the investment side as a VC, and then being an entrepreneur, you learn the what do they call them, dirty little secrets of both
Yeah.
sides. So you know how it works. Well, that's awesome. And with that, I'm going to let you jump in. I don't know where you want to start, whether you want to start with a C Corp. Maybe we start with a sole proprietorship, because that's usually what people start with. And I know that there's some issues, let's say, around sole proprietorship. So we start there, and then you can just drive how you want to go. I don't know if we rank them by best solution to or worst solution to best solution, or however you want to do it, JJ.
Well, the way I always like to start is by taking a look at what do we want to accomplish. And part of what I always tell people whenever I'm speaking or visiting with a client, or just even in just on one-on-one consultations, where I always say that we have to understand that the government and other sources are attempting to place what I call a lid on wealth. And that lid is an acronym for the three legal pitfalls of lawsuits, income taxes, and death taxes. So that's that acronym, LID. And I say, what we've got to focus on is taking the lid off. Well, how do we do that? If we're concerned with lawsuits, income taxes, and death taxes, we've got to make sure that we focus on three essential areas. And those three essential areas are asset protection, estate planning, and tax reduction. And if we recognize that right from the very beginning, that these are the three things that we've really got to, concentrate on, then we say, well, which entities can give us the best overall benefits and best approach? And here's something that I want to make sure that all of our listeners and viewers understand, is that you kind of hit the nail on the head when you said, the question that most people have is, what type of company should I have? And I don't know the answer to that. Now, Brandon, obviously that's not
Well, that's a
right
good answer. I mean, that's a good answer.
But people think that they think, well, you're just going to give me the answer, and when I say I don't know, they're saying, well, I thought you were the expert. Why are we talking to you if you don't even know the answer to that question? And I say, the reason I can't tell you the answer to that is that I don't know enough about you and your situation and your unique circumstances to give you that answer first.
Right.
And the reason I point that out is because a lot of times people think that there's just going to be just a general rule, one size fits all plans. And that's what I want to make sure that people understand. That's not the way that things work. You've got to make sure that you understand, what type of industry are you in? And that will determine what type of income you're generating. And depending upon what type of income you're generating, that determines what type of entity you may need from a tax standpoint. And we'll get into some of this today as far as when I'm talking about income, we've got earned income and unearned income. And a lot of that is it generated from active activities or is it from passive activities? Working with a lot of real estate investors in particular, you've got different types of real estate strategies that you're able to utilize in order to generate your income. If you're flipping properties, that's more active in nature because you had to physically be doing the things as far as going in, buying the properties, doing the rehab, making all of, those are actions that you're taking. And because of that, that's active income. If it's active, now it's earned income. If it's earned income, it's going to be subject to the FICA tax. And, I know we're jumping in kind of pretty quickly here.
I like it.
But that's kind of, you told me, hey, this is kind of straight talk here.
This is it.
Yeah. So with that FICA tax, that's your Medicare and Social Security taxes. Well, basically those two add up to 7.65%. Well, the employer pays 7.65% and the employee pays 7.65%. Well, as you know, and your listeners and the viewers know right now, as entrepreneurs, you're both. If you work for yourself, basically, you're the employer and the employee. Well, if you're the employer and the employee, that means you pay both sides. So 7.65 in both capacities, you got to multiply that times 2. Now you're at 15.3%. And that's just for your FICA. That's before we even looked at income taxes.
Yeah, that kills me.
Yeah, so there are structures that you can put in place that can help you avoid that. Now, if you just, and we'll talk about those particular structures, but let's compare and contrast that for a second. Let's say that you are involved in real estate and you have rental income. Well, rental income is passive income. Because it's passive income, it's considered unearned income. As such, it's not subject to the FICA tax. So now that takes a different type of structure. And we'll kind of take a look at those different types of structures, but that's where I talk about right there, that was a consideration with regard to taxes. So it had nothing to do with liability protection yet. We've got to make sure we have liability protection. And that's what I always look at from the very beginning is that, one of the things you referenced when you were first talking about the different things that we may look at as far as different types of business structure, you made reference to a sole proprietorship.
Yep.
And I know you were partly setting me up on that, Brandon.
That was a slow pitch.
Yeah. You're setting me up because one of the things that I always tell people is that personally, I think sole proprietorship should be outlawed. I really do. And part of the reason for that is that I think it should be against the law to put your assets at risk like that. Because let me tell you what I mean. When I say putting your assets at risk like that, basically what's happening is that we recognize that, there are risks involved in starting your own business. I mean, I don't know the latest percentages, but it's a pretty high percentage of all businesses fail
Right.
in the first year, much less their first 5 years. So you look at this, and if that business is going to fail, you may have your entire life savings at risk. Well, you've got to separate that out because if you don't have a limited liability type of structure in place, what happens is that now all of your personal assets are at risk. So if there's a lawsuit or if there are debts that are incurred on behalf of the business, those are going to pass through to you in your personal name, and now you could potentially lose all of your personal assets. A
Mm.
lot of times people, especially nowadays, one of the hot things is to kind of set up a side hustle.
Yeah, that's really hot.
It's really hot right now, and for good reason. Because you start thinking, hey, I've got a saying with regard to business, but also with entities and things. I say, don't go into it, grow into it.
Hmm.
And one of the things that a side hustle allows you to do is maybe you've got a good job, but it's not where you see yourself for the long run. Well, rather than just quitting your job and saying, okay, I've decided I'm going to start this new business, why don't you kind of get it going on the side? And then it's almost kind of like an elevator where you say, well, right here, you're on this floor with your job and you're growing your business up. Well, wait until that business gets to the same floor before you jump off to start the new business.
Yeah, I want to interrupt you right now because I
Yeah,
think that's a really important point to make is that I get these entrepreneurs who come and I mean, God help them. Some of them come to me and said, I quit my job. And my first question is, okay, what's your burn rate? And they're like, well, that's not what advice I want from you. And I said, it's not about what you want from me, it's what you need from me as it
that's
relates to that point where, and I just want to emphasize that for entrepreneurs listening out there, because side hustles are good, great. And be honest with you, every company that I've ever started has all come from a quote unquote side hustle. Um, because I know how long it takes to get that going. But I think it's important to say, and this is sort of a little off topic, but until you got your burn rate covered, please don't jump ship yet and build that side hustle, but protect it, I think is where we're going with you, JJ, so that you're not being exposed personally along the way.
Well, and it's interesting that you say that, and I think sometimes when we're making kind of some of these side comments, they're very important. And sometimes I think people will hear different, I don't know, advice or illustrations or things that they think that they're doing something really good, such as burn all the ships. You talk about like the strategy sometimes going in. You say, hey, let's burn our boats so that we can't retreat. And I'm saying, that sounds good in theory, that you're giving yourself no alternative, but I'm saying that can also be quite dangerous.
And
So
especially if they haven't done their homework. And I think
that's
that's an important, like, if you want to burn the ship, I'm okay burning the ship, but at least have a plan that when the ship's burnt down, you actually know where you're going to navigate to. Cause
that's right.
and I think that's what we're really saying.
Yeah, and that's the key because I'm all in favor of risk, but I'm mostly in favor of calculated risk.
Right.
So, and the other thing is we can minimize the risk by increasing our knowledge, and that's part of what we're doing here by talking about this asset protection. That if you say a lot of times people will say, I'm just going to start off with the sole proprietorship. I say, okay, well, you're starting off at your most vulnerable phase with absolutely zero protection. Why on earth would you do that? And really, whenever I'm speaking to a group, I kind of say, what's the most popular entity? And people will say, well, sole proprietorship. I say, why is that? Because really, I'll kind of take them through a progression where we start off, we said asset protection, estate planning, tax reduction. I said, of all of our different structures, which one gives us the least amount of asset protection? And people will say, sole proprietorship. I say, okay, which one gives us the least estate planning? Sole proprietorship. Which one gives us the least true tax benefits? Sole proprietorship. And I say, and guess what? Which one's the most popular? Sole proprietorship. We say, now that's crazy, because why on earth would the most popular choice be the one that gives us the absolute least benefit? And I ask them why that is, and they'll say, well, because it's the cheapest. And I said, that's right, but I have to tweak it a little bit and say, it's not the cheapest, it's the cheapest to set up, because it doesn't cost anything to set it up. I said, I wonder who made it that way. Who made the laws where it's very cheap to set up a sole proprietorship? Maybe the government, and maybe the one that's going to benefit from you paying the maximum in taxes.
Right.
So we think they've got good reason for that. And the government made it very easy, and they made it very cheap for you to pay the maximum in taxes. So no wonder they have it this way. But I personally feel like it should be outlawed. It won't be, because the government wants you to be paying the top tax rate. It's just kind of crazy, but it should be really against the law to put your assets at risk like that, because what happens is that maybe you're starting on this with that side hustle, and then you get sued, and you think, well, that's not that big of a deal. No, it's a big deal, because here's the thing. Let's say that you're going along, all of a sudden somebody sues you for $250,000. Well, in today's society, a $250,000 lawsuit is tiny. It's not going to make the news. It's not going to make the newspaper. It's not even going to show up on the radar. But I always ask people, I say, what would happen to you and your assets if you were sued for $250,000? And they say, after they take a pretty big gulp, they say, I'd be devastated. And that's exactly what happens, because the thing is, what if they don't have $250,000 of cash to satisfy that judgment? Well, if they don't have the cash, then they'll seize the assets. They seize the assets, and now you may have to sell $500,000 worth of assets to free up $250,000 in a fire sale. And then now it really costs you $500,000. But I always tell people, I say, but there's some good news. You saved yourself a couple $1,000s that it might have cost you to set up your entity.
Good job.
Exactly. You showed them, right? I mean, that's kind of crazy, but that's the way that a lot of people think. It's just short-sighted. And I say, yes, it's going to cost you a little bit more money to set up a corporation, to set up a limited partnership, to set up a limited liability company. But you know what? It's well worth it, especially in the event that you get sued. But the thing is, it'll pay for itself just in the tax savings. So, and that's part of what we'll talk about as well.
Yeah. So let's just use an example of because I think this side hustle thing's a great example, and I didn't even think of it, and a lot of people are doing that. So I have a side hustle. Clearly you shouldn't be a sole proprietorship. And I'll just throw another log on that fire, JJ, and say, if you get sued for $250,000, that's the amount that they're suing you for. But you, if you lose, will also pay, and you can confirm this because I'm not a lawyer and you are, is you will also pay your legal fees and all of theirs, potentially.
Sure. Yeah, potentially. Yeah. I mean, you're definitely going to pay all yours.
Well, for sure.
You could potentially even have to pay theirs.
Which is crazy and adds up. I mean, it's just enormous. So I put that log on the fire, but okay, I got a side hustle. I'm generating, decent amount of money, even if I'm not. I'm going to go into it. Where do we go? How do we navigate it from here?
Okay, well, the first thing we want to consider is we've got to have limited liability, okay? Because before we've made our first dime, we're probably not all that concerned about taxes. But what are we going to be primarily concerned with? From the very beginning, you've got to be concerned with asset protection. That's limited liability. And whenever I tell people, I say limited liability, what you need to recognize is, like when you set up an LLC, for instance, and that'll be one of the entity options that we discussed. But a limited liability company, what that really tells you is that your liability is limited to the company. Now, that sounds, it's kind of like, okay, well, thank you for clarifying the obvious for us. But I'm saying it's not obvious to a lot of people, because a lot of people think, hey, I don't have to worry about losing anything. I say, oh no, you'll lose everything, but everything that's in that company. So with that thought in mind, this is one of the first points that I've got to make sure that we understand, Brandon, is that, people will say, what is the one entity I need? And I told you earlier, I said, I don't know.
Right.
But on top of that, it's not just one entity. Chances are you're going to need multiple entities because you may have different parts of your business. Now, again, you don't necessarily start with that. Don't go into it, grow into it. As your business starts taking off, now you may say, okay, we've got to acquire maybe some equipment or some other types of assets. Well, that may need to be held in a different legal entity that is then leased to your operating entity. And these are some of the strategies that I work with people on, making sure that they understand this. But from the very beginning, I'm going to back up just a second and say, you got to set yourself up with a limited liability type of entity. For years, that was, either maybe an S corporation or a limited partnership. And then in more recent years, and when I say more recent years, I'm probably dating myself a little bit. Basically as of, I think, 1999, I think all states had limited liability company acts on their books.
Okay.
But that's relatively recent. I mean, people listening to this or watching this right now may be saying, that's 20 years ago. That's a long time. Yeah, but if you look at the case law compared to how long corporations have been around, it pales in comparison because, LLCs are essentially kind of like the new kid on the block when it comes to legal entities. So, but they're also more clarified and you understand how they're going to work a lot better. So typically I'll tell people, if you're getting started, I would generally tell you need to start with a limited liability company. And here's what you have to understand. Limited liability companies are very versatile. That's part of why I tell people that that's what you need. And limited liability companies are not super clear as far as how they're taxed. They can be taxed in multiple ways. According to the IRS, there is no limited liability company taxation. The limited liability company starts off, and it's either going to be a disregarded entity, which if it's a single member LLC, so it's just you, it's typically going to be a disregarded entity. So what that means is that it's going to be taxed like a sole proprietorship. That's okay because we're still getting limited liability protection.
Got it.
Now, if you have multiple people, you're going to initially, by default, probably be taxed as a partnership. Well, a partnership, that's a pass-through entity. Now, with pass-through, it means the LLC doesn't pay taxes. The income, after all the deductions, all the expenses are taken, passes through to the owners, and then the owners pay taxes in their personal tax bracket, on their personal tax return.
But it's still ordinary income.
Yeah, well, it can be. It can be because if it's passed through as partnership, if it's, say, rental income, like we kind of talked about earlier, that could be passive income.
What about just I got a side hustle and I'm selling products?
That's generally going to be earned income.
Yeah.
So that's going to be subject to the FICA. So if you're selling products or services, that's going to be taxed as earned income. Well, that's why sometimes people will say, okay, as an LLC, I'll elect to be taxed as a corporation. Well, initially, you're going to be taxed as a C corporation because what you're going to have to do is you're going to file your taxes as a C corporation. So you're going to be filing an 1120, and a C corporation has its own separate tax bracket. There are potential challenges with that because then there could be the prospect of double taxation, which means the corporation pays taxes. Then if you pull money out to yourself, you're going to have to pay taxes for the second time, or first time for you, but that income is being taxed for a second time. So what people will do is that they'll choose to, after they've elected corporate taxation, then they'll make their S corporation election. Now, when you make that S corporation election, that's how you're able to avoid the FICA tax. So that's part of the benefit of having an S corporation. So I know that's a lot to kind of take in when we start off, and I'm right out of the gate. I'm saying, okay, boom, LLC, and then out of the LLC, you've got to choose all of these make all these determinations. It may just be if it's just you getting started, single member LLC, disregarded entity, taxed as a sole proprietorship, you still got the limited liability protection.
Yeah, that's an important part. Step one, and I love how you do this because you really make it digestible and you start to cover the bases that anyone really needs to be covered, which is get that liability, keep your house protected, keep your car protected, your life insurance policy for your significant other, both ways, whatever that is. and then move into, if you start growing your revenue, now you've got to really be strategic, right? Because, I just feeling the pain sitting here with when you're talking about double taxation and
Right.
all that stuff, even being taxed as a sole proprietorship. And I think the S corporation is not understood um, uh, well enough. I know that, and maybe you could elaborate on that, and if you want to go somewhere else. But I'm interested in how, as you walked us through there, I'm like, okay, well, now that S corporations, as we're growing our revenue, starts to become appealing because we don't pay this
Oh yeah.
FICA tax, but that has to be set up correctly anyway, because you do have to pay yourself, right?
That's right. I mean, and what we look at though is that you've got a lot more options and flexibility. And really that's what we're looking at, making sure that we have as many options, because that's the key to everything. Because you
Right.
don't want to pigeonhole yourself into just being stuck doing it one way. Um, One of the things that I tell people, and I think this is vitally important, if you notice, you're asking me these questions to take you through the process. But a lot of times people come in, they say, I don't know, you just tell me what I should be and just set it up.
Well, you can't do that.
And the thing is, there are attorneys that do, there are companies or there are CPAs that'll say, yeah, here's what you need to be an S corp. It's not necessarily knowing what, it's knowing why.
Right.
And that's part of where, I told you how I first started was that I said, I would like to not only do this, practice law, but at the same time, educate people. And the way that I do it is that when I'm educating people, say through my seminars or through my various courses that I offer, through the books that I've written, it makes them a better client in the long run. Because if they understand what they're doing, they're going to be a lot better at doing it. And then if they're better at doing it, it makes my job easier, which in turn makes their job easier. So it's kind of like we all win. When people will say, just do it for me. And I'll say, okay, well then I'll do it for them. And then they have no idea what they're doing or why they did it that way. And it becomes problematic because then they face different things in their business. And then they're calling me saying, well, how come I did this? But here, let me explain it now. And then rather than having learned it early on, they're having to spend my time doing this where maybe now they're on the clock, an hourly fee.
Of
So it's
course.
costing them far more than if they had just gone the education route to begin with.
Yeah, and I think it pays as entrepreneur just to understand some of these things. I mean, ultimately, we're going to get taxed, right? So we're going to try to minimize that tax. And correct me if I'm wrong, I always shoot for a capital gains long term if I can, or some
Sure.
sort of dividend, because then I don't have these FICA taxes and all this other craziness. So I'd rather be taxed as a type of investment, if you will, um, than this ordinary income. And that's how I've sort of operated. Is that how people should think about it?
Well,
Or
it is, but I tell you that there are different ways of looking at it, and I've had to, basically adapt my way of thinking to understanding what other people may want. Because a lot of times, especially entrepreneurs in many instances say, hey, it's all about, I want to make as much money as I can. I'm building my wealth in my business. But then there's another way of looking at things. A lot of people build their wealth more through retirement plans. So
mm,
what they're doing is they're saying, let me set up a 401k or let me set up an IRA. Maybe that's, especially if you're able to, doing a Roth IRA where it's able to grow, tax free. You know, 401k, some of the other ones, they're more of a tax deferred, but then there are also retirement plans that is completely tax free. And you think, how on earth did they ever let that pass? Because when you look at it and you say that can be, incredibly powerful, but you've got to make sure that you're able to do this. That's going to be funded with earned income. So you may want some earned income for things like that. But a lot of entrepreneurs say, yeah, forget the 401k. How about just building up my business? Now I sell it for $1 billion. And, granted, those are, for the most part, few and far between. But hey, stranger things have happened. Everybody started off, all of these big time companies started off, just as an idea.
right.
So that's one reason why you may want to have some earned income is being able to do that. And then if you structure your retirement plan the right way, you can utilize what's called self-directed IRAs. And with the self-directed IRA, you can, if it's structured the right way, you can even use those funds to invest in real estate,
Mm.
which is appealing to a lot of people.
And
Um,
can you use that? Could you use that not just for real estate, but even a business entity? I
Well,
mean,
it just depends,
okay.
because you've got it. There are a lot of different rules when we're talking about retirement plans as far as prohibited transactions. Then you've got unrelated business taxable income. You've got a lot of things that you need to be working with an expert in that area, because I can assure you that's not an area that you want to just say, hey, I'll just, it's easier to ask forgiveness than it is permission. No, it's not.
Yeah,
I may go into that category in some areas, not when we're talking about retirement plans.
yeah, this is complicated stuff.
It really is, and it can be. But here's the thing: some people just shut down because it's complicated. And what I tell them is that, hey, you don't have to be the expert on all these things, but you need to work with maybe what we'll call your mastermind team, as Napoleon Hill would call it
Mm.
in the book Think and Grow Rich, or maybe some people refer to it as your power team. Put together maybe a board of directors that's made up of various professionals that can give you that guidance, because the key is understanding in advance, because that can help you make the right moves. Sometimes people will just move forward, they make their moves, they take action, but they haven't thought about it in advance, and they say, oh well, people will fix it after the fact. No, if you can go into it, is back to what we said of taking calculated risks. you know the only way to take a calculated risk is to calculate it. We've got to
Right.
make sure that we do that from the very beginning. A lot of people skip that step. So we've got to structure ourselves the right way, and a limited liability company can be a great way to do that.
Okay. Well, I feel overwhelmed and confused. Enough here. Take us through the other entities, or how really, I don't want to guide this. I want you to guide it because you know more than me and us.
Well, here's the thing. Whenever I'm speaking to a group, I'll start off and I'll say, here are the different options. I'll say, we got a sole proprietorship, we got a general partnership, we got a limited partnership, we got a limited liability company, and then we got corporations. Well, with sole proprietorship, we already talked about that. It's pretty much the worst one until you hear about a general partnership. Because with a general partnership, basically what happens, that just means that you're working with somebody else, and that happens all the time. If you're on your own, by default, you are automatically a sole proprietorship. If it's two of you, by default, you're automatically a general partnership. Now,
Mm.
the challenge we have with a general partnership is that basically you're not just on the hook for your actions. And in the event that you do something that causes somebody to file a lawsuit against you, you also have personal liability for the acts or any lawsuits filed against your partner.
Without you even, this is just, hey, JJ, let's build a business.
Right.
We become a general partnership just like that.
Absolutely. That's right. So then let's say that your partner, for whatever reason, decides to have, maybe a couple beers with their lunch, and then they get into a car accident, headed back to the office. Your entire net worth could be at risk because of their actions. You didn't do anything wrong other than partnering with them through a general partnership.
Which you didn't even formally do anything other than go into business, have an agreement, and probably have a checking account in this business
Right.
name. Is that about right?
Well, and here's where people don't, sometimes they'll unwittingly subject themselves to the general partnership. And I'll give you a quick for instance. I work with a lot of real estate investors, but this could be for anybody. That you say sometimes deals work where one person says, hey, I'll put up all the money, but you do all the work. And, vice versa. The other person says, hey, I'll do all the work, you put up the money. And the person putting up the money thinks, okay, I've got a limited potential for loss. Maybe I'm putting up 10, 20, 30,000, whatever it may be. And they think, okay, if I lose my 10, 20, 30,000, obviously that's not what I'm going into this for. But if I do that, it's not going to destroy me. But now they're in a general partnership. Because they're a general partnership, because they didn't draw it up the right way, where it was maybe either a loan or an investment, they did it in a way that was just, hey, we're just both partners. And because we're partners, now that person that does something that causes a potential lawsuit, they've now subjected the investor to personal liability.
Mm.
So we've got to make sure that general partnership's awful. So really, if we're looking at those
Sole
options,
proprietorship in general,
get rid of those.
if you have not done some sort of legal paperwork, it's
You're one of those.
yeah, you're in trouble, or
That's
it
right.
could.
And you're automatically one of those. And that's the thing, because you can't even say it's not an act of commission, it's an act of omission.
Mm,
Because what they've done is they've not done anything. And because they haven't done anything, that's what caused them the problems. So what I'm telling people is you've got to do things, but you've got to do the right things. So what that now leaves us with is the limited partnership, the limited liability company, and the corporation. Well, I'm going to first take a look at the limited partnership. And this is going to kind of tie in to the need for multiple entities. And with the limited partnership, here's how it works. Basically, you've got a general partner and you've got limited partners. Well, the general partner controls everything, calls all the shots, has complete say-so in the day-to-day operations of the business. The general partner controls the checkbook. Now, the limited partner, on the other hand, has zero control, calls none of the shots, has zero say-so in the day-to-day operations of the business, has zero control over the checkbook. Well, if you were to ask most people, which one would you rather be, the general or the limited? They say, well, hold on a second. As limited, I have zero control. As general, I have all the control. Well, geez, I want to have all the control, so I choose general. You say, okay, that makes sense because control is very important. Well, here's the challenge with limited partnership. The limited partners have limited liability protection, meaning
mm.
the maximum they stand to lose in the event that something goes south with this overall limited partnership business, maximum they stand to lose is the amount of their ownership in that limited partnership. The general partner, on the other hand, has unlimited
Mm.
liability. Essentially, they've got personal liability so that in the event that the business is sued, now we understand if a business is sued, you're going to lose your investment in that business. So let's say that the business was worth $100,000. Somebody sues you for $200,000 and they win. The maximum they can get is the $100,000. Except when you're in a limited partnership, the general partner is now personally liable for any of the potential
Personally
debts.
liable.
They're personally liable. So what
Wow.
happens is that if that lawsuit was $200,000 and there was only $100,000, that's insufficient to satisfy that judgment. So what happens is now the general partner is personally on the hook for the overage, for the additional $100,000. So now if you ask somebody, you say, well, which one would you want to be, the general or the limited? Well, now they say, well, obviously I would want to be the limited. We say, all right, you're confusing me. Because first you told me you want to be the general. Now you tell me you want to be the limited. Which one do you want to be?
Well, they're reacting. They don't have a strategy, and that's the point, right?
That's right. Now here's where a good strategy, and you mentioned they didn't have a strategy. Here's where a strategy comes in. We've got to take a look at things. We say, stop thinking like individuals, start thinking like entities. Because what if we structured it where the general partner was an entity? So maybe we utilized an LLC or we utilized a corporation that served as our general partner. Now we've got limited liability protection for ourselves as limited partners, and then we've got limited liability protection that's afforded to us through the use of that entity that serves as the general partner of the limited partnership. But see, the downside of that is that it requires two different entities. A lot of people will say, well, I don't want to do that. I don't want to have to set up two separate entities. And I say, well, hey, that's what saved you in that scenario. But that is a limitation on a limited partnership. It's a way to get around the downside. But if you understand that, you say, hey, that can be pretty good. But people such as yourself that live in California are now saying, hey, that's two entities. Now I've got to pay the state of California two franchise tax fees every year of $800 plus the annual fee. Now you're saying, okay, well, that cost me an extra $1,000, let's say, to have that extra entity. Well, it'd be well worth it. Well, this is where a limited liability company comes into play. What happened, years ago, people would set up that structure like I talked about. When I was first getting started with limited liability company, was a brand new entity. We would structure people with a limited partnership with maybe a C corporation as the general partner. That was a great structure. It's still a great structure today. Now, with the limited liability company, what happened was that now you get all the control, but you don't have the personal liability. It can be managed by a manager, and that could be somebody that is, involved with the limited liability company, maybe as a member, so it's member managed. Or it could be manager managed, where it's an outside manager, which now kind of falls back into the category that we had before, where we've now kind of got maybe a new entity that serves as that manager. So we've got things put in place where we've got multiple options. But again, now that we make that decision to be a limited liability company, now we've got to choose how we want to be taxed. And we've already kind of covered that.
Right.
But these are just some of the considerations that I take people through. Then finally, we have the corporation. Now, with the corporation, generally, and I tell people anytime if I use the term corporation, I'm talking about a C corporation. I'm talking about an S corporation because I'll use the term S corporation.
Okay.
So I want to make sure that when I just say corporation, people know C corporation.
C corporation. When we talk about corporation, it is a C corp, and otherwise we talk about S corp and
That's
name it S corp. Okay.
Yeah, and that way you know for sure. With a C corporation, it's a separate standalone entity. It's got its own separate tax bracket. It files its own separate tax return, which they all file their own tax returns, but it pays its own taxes. So you look at that and you say, hey, this can actually be pretty good. We used to have a downside where we'd start off and we'd say from $0 to $50,000, you were taxed at 15% tax bracket, which, hey, that's pretty good until you bump into the next tax bracket, which was 25, and then you kind of go up higher, anything above, and it started getting somewhat oppressive. Well, now with the new tax act that was passed and under the current tax code, now C corporations pay 21%, just basically on all income. There aren't brackets anymore.
Flat.
Just 21%. That's right. Now so that can be very beneficial. The downside, however, is that you've got to take the money out of the corporation somehow. Now, that's where you have the potential for double taxation. If you pay yourself a dividend, that's going to be taxed to you. Now, it's passive, so you're avoiding the FICA tax, but you're still going to have to pay income tax on that dividend income. If you paid a salary to yourself, that's deductible to the corporation, so the corporation isn't paying tax on it, you're paying tax on it, so it's only one level of taxation, but a salary is earned income. So now that earned income is subject to FICA, so you've got that extra 15.3% tax. Now, that's not to say a C corporation is bad. It's just, because obviously you think about, some of these huge companies in the country, they're set up as a corporation, and there's a reason for that. But for most people starting off, a C corporation is not going to be their primary entity. That being said, it very well could be an additional entity that they utilize. That maybe they utilize it for something such as maybe they've got assets that they purchase these assets through that corporation, and then that corporation leases those assets to their LLC. That's a strategy that people utilize a lot of times. So the key is just knowing that we've got different options available to us.
And there's a whole other level of this, right, JJ, that the ownership and the stock itself has to be done correctly, because you got to do the right filings so that you avoid these potential taxes down the road, and that you could get hit with, because you could actually wind up with your stock being earned income.
You can't, and then there are other things that, like, sometimes people say, well, just leave the money inside the corporation. Well, they've got ways that they get you on that. It's called an accumulated earnings tax. So that if you just stockpile money inside your corporation, at a certain amount, you've got to disclose that of how much you're carrying over. So the IRS keeps up with how much extra money you have, so that they know what happened to that.
And are there limits on that? How does that work?
Well, if it's anything over $250,000, that's where you've got to disclose that and say,
okay,
how much cash do you have on hand? If your income was over a certain amount of money. So that's where you're looking at this, that we've got to make sure that we understand that. And that's where a lot of times people will say, I'm just going to have, I'm going to do TurboTax, or I'm going to do my own taxes. Say, no. You can, especially when you're just starting, but I promise you, a good tax accountant will pay for themselves many times over.
Well, I'm going to, to all the listeners, give an example. I'm not going to name any names here, but my wife has a friend, and every year, generally, my wife and I have been pretty good with taxes, and we have a really good accountant who knows the laws, just like, from a legal standpoint, and minimizes our taxes with all the legal things that could be possible, of which TurboTax and these other things, I just don't think, I never had faith that they knew the intricacies, because they're not built to be customized to the White House here. They're customized to be more general. And her friend said, well, how come you guys always either get money back or you don't owe taxes? And Yvette said, well, we pay an accountant. And she said, well, that costs you a few $1,000s. Yeah, but every year you owe taxes and we
Right.
don't. So I think there's one thing to say to do it yourself, but to pay a professional who knows more and lives it every single day. I
And
mean, the
they know,
ROI is
they know
huge.
loopholes, they know things because, I mean, as with any, computer program, you start looking at, the whole GECO, garbage in, garbage out. It's what are you putting in there? We've got to understand. I mean, it's not going to tell you when all of a sudden you input something there's, oh, well, why did you purchase this? Was that for a business? And so if that was a business purchase, you may be able to deduct that. They're not going to tell you that. The IRS is sure not going to tell you that. So if you have a good tax accountant, they may say, well, hold on a second. I noticed you had this trip that you took. What was that trip? And you say, well, I attended a conference. Okay, well, as an individual, that's not going to be deductible for you. But for the business, absolutely. The expenses of traveling down there, attending the conference, you know, everything that you incurred while you were down there, that's going to be deductible to you. So that gives you some added benefits. But you're not going to necessarily know that unless you have somebody that assists you with these things. So, like I said, they're going to pay for themselves many times over.
And we just transitioned a little bit into accounting, but we'll go back. This is the same thing with setting up your entity.
That's
I,
right.
I mean, that you got to have someone who's like yourself who knows this and can say, Brandon, tell me what your situation is, where you are today and where you're going. And then let you go use your mastermind to figure that out and make a recommendation and then build that. It's not completely custom, but it is custom. It's,
Oh, absolutely. Well, and especially the customized part of it is understanding how they work together. And like I said, you may have, especially if you've got multiple businesses, you're going to need multiple business entities. And if you've got multiple business assets, you're going to need multiple business entities. And on top of that, then you've got to understand how are those entities owned? Ultimately, what's your estate plan? Remember, we started off, we said lawsuits, income taxes, and death taxes. Well, we combat those with asset protection, estate planning, and tax reduction. We've talked about the asset protection and the tax reduction. We haven't talked about the estate planning yet, so let's talk about that for just a second. I haven't talked about a living trust yet because it's not a business entity. Now,
mm.
that being said, it is an absolutely vital part of your overall plan. And the reason for that is number one, you've got to have an estate plan so that you know where your assets are going to go whenever you pass away. You've got to know what's going to happen if you got sick. You've got to know what's going to happen if you weren't able to act on your own behalf. Do you have powers of attorney in place for not only your general and financial matters, but also for your health care? Do you have a living will as part of your overall estate plan? Do you have your HIPAA waiver and release in effect so that the medical professionals can discuss your circumstances with your trusted family members or friends or whoever that might be? You've got to have all this in place. Do you have the circumstances laid out for who's going to receive certain assets? Do you have a plan in place that's going to help you avoid probate? Well, because what's going to happen to your company whenever you pass away? All of that is laid out through the trust agreement and the ancillary documents that make up your overall estate plan. So really, when I speak with groups, I begin by talking about the living trust because that's the foundation upon which we build everything.
Well, let's
So,
talk about that. Yeah, because that's super important.
well, you got to have, I mean, here's the challenge, Brandon, is that a lot of times people will think, you hear estate planning, and the first word there is estate. A lot of people mistakenly believe, well, I don't have an estate. I mean, when I think the word estate, I was conjuring up images of grandeur.
Right.
I'm thinking about this, mansion or this, Downton Abbey or something. And you say, well, sure, that's an estate, but at the same time, everyone has an estate. I don't care if you're homeless living on the street corner, you still have an estate. So we've got to make sure that we plan the estate, because if we don't have a plan for our estate, the government has one for us.
Yeah, and that's really painful, which I've
Exactly.
met some or heard some horror stories of how that goes, and it's ugly.
Yeah, because now you've lost control. You want to make sure that you remain in control, that you've worked hard. Spent your entire lifetime building up whatever it is you have today. You want to make sure that those assets pass to whoever you want those to pass to. I started to say to your family, sometimes people may say, yeah, I want to pass everything to my family. Sometimes people may say, well, I want a portion of it to go to my family, but then another portion may go to my church, may go to my favorite charity, may go to a cause that they champion. Those things all have to be laid out, because if you don't have a plan, you're not going to have any control. Everything's going to follow the laws of intestate succession, where the government says, okay, here's how your assets will be distributed upon your death. And one of the things, part of the reason that I always talk about a living trust is it's not because it's going to save you a whole lot of estate taxes. Fact is, nowadays, the estate tax does not impact that many people, because the exemption amounts are high enough that it doesn't really touch that many people. So estate taxes is not the primary motivating factor here. It's probate avoidance. We want to avoid the probate process because, in many instances, especially if you have a business and if you have a bunch of real estate, you have a bunch of assets, probate can be devastating. For some people, you'll hear some people say, hey, probate's not that big a deal. Well, it may not be that big a deal if you don't have any assets, or you have very simple assets. But
Or you're dead and gone and you're not dealing with it. How about that?
I've had people that say that. They say, why do I care? I'll be dead. I
Yeah,
said, well,
well,
is
you
that how
do
you want to
care.
treat your family?
Yeah, exactly. Like they're the ones, and that's what I've seen is the impact. So I was only joking like that. I mean, you should care.
Exactly.
That's not a very good answer. It is
That's
an
right.
answer, but it's not a good
But
one.
it's, the thing is, you were kidding, but that's how a lot of people look at it. And I say, hey, that's short-sighted. We've got to be thinking, and even as part of your overall estate plan, you've got to think about things such as, do you want to be buried or do you want to be cremated? Do you want to have a celebration of life service or a memorial service? Are there certain people that you would like to be involved maybe as pallbearers? Would you like certain people to be in charge of the eulogy, certain people to speak at your funeral? Those are things that need to be planned out in advance. And it's not something people want to think about, but at the same time, you've got to think about this and put a plan in place. That's part of your overall estate plan. So you see how all this ties together, Brandon? It's
Yeah,
like,
you're blowing my mind. To be honest with you, you're bringing up like me remembering all this stuff, and I'm sitting here thinking, what are the listeners thinking? They think they're listening to an entrepreneur podcast. Well, you are. That's the story here, right, JJ? They are listening to an entrepreneur podcast, and this is or business owner, however you identify yourself, and everything that you've just said is part of that process.
That's exactly right. And that's kind of what I would say, is that this is a process. I mean, when all is said and done, it's a process that you've got to go through, but it's also something that needs to be addressed on a regular basis. It's not just one and done type of a format here. This is something because when I say don't go into it, grow into it. What are you growing into? As you're growing, is your plan growing alongside you? That's something that you've got to take a look at on a regular basis.
And I think that the lesson that I would pass on to listeners is, I learned some of these before I met you, and even with experience, to be completely open, like I've made mistakes and gotten out by the skin of my, or what do they call it, the hair of your chin, like, and basically said, I got to get my stuff together. And you do not want to be in those situations. And a lot of the things that you brought up today, especially, I was thinking of another entrepreneur friend of mine who had a whole bunch of patents. And I remember the lesson I learned from him was learning how he structured his company is that those licenses and patents were held in another company and
Right.
were licensed to this company. And, I hear what you hear sometimes is, oh, Brandon, well, I got to pay, what is it, JJ, $800 in California for your LLC or your C Corp
Mhm.
or whatever it is, plus your local town fee. I know here in Half Moon Bay, when I filed ours, there's a fee there. But when something happens to that one entity, you've protected those other assets
That's
in
right. I mean,
another
it's cheap
place.
insurance if you look at it that way.
Exactly. Um, so what else have we not covered that would be important that we should tell our listeners? We didn't talk too much about an S corp. Should we talk about that a little bit?
Well, we did actually, because
Okay,
remember we talked about the fact that because it changes the nature of your income from earned to unearned income, which is going
got
to
it.
be that FICA, which is the primary reason why you would do that.
And just so I understand, that's not really our listeners shouldn't take that as just, oh, let me go run and make an S corp because it all made it non FICA income. Because the truth is that even that S corp has to be set up correctly. Correct me
Yeah,
if
well, there's a process that you have to go through. Because remember when I was talking about, like, let's say you do it, if you're just doing a straight up S corp, what you do, you still have to set up a corporation.
yeah.
Then you're going to get your, entity classification form. I think it's form 8832. So you're going to have to do that. Then you're going to have to do your S corp election. When you look at some of these things, it's pretty kind of an involved process. To somebody that does this on a regular basis, it's not that big a deal, but it can be quite overwhelming if you just say, okay, let me just do this. And then you don't know why you did this. And then something comes up later and, you're limited as to the number of investors that you can have, depending upon what scale you're on, that can come into play. So these are just things that you've got to factor in. And long story short, I think the primary thing that I would make sure that people understand, I'll be the first to tell you, there are certain things you could do on your own. Your estate plan and your overall entity structure is not one of those things.
Yeah, I mean, if anybody is listening, take that away. And we, I mean, I don't even have my timer here, but in the last, let's say, hour, we've talked about. I mean, we could sit here all day long and talk about each one of these entities, right, JJ? I mean,
Sure.
you and I probably had sitting eating dinner after
Yeah.
doing a presentation, had long discussions. At some point, I just say, "Hey, JJ, here you go, man. Here's what I got. You go make your recommendation and handle it." And um, I think that's the way it really people should approach it. And I also say that this isn't a one and done.
Right.
I mean, because my business changes, right? Let's say this year we created a technology asset. Well, that technology asset shouldn't sit along with all these other assets. So we're going to have to spin that out. So I think that listeners should understand that it's not a one and done. It's not, I think
Right.
people think, oh, I'm going to file that paperwork in Delaware and what everybody says, Delaware, wherever state, which is a whole nother discussion, right? Because different states, there's an advantage to doing it in different states.
Sure.
Um, and then I'm done. No, you're not done. You need really someone to be watching.
Yeah. Some people, what people want sometimes is a set it and forget it.
There you
Well,
go.
that's not how this works.
Yeah, that'd be like saying set it, forget it with your business. Just I'm just
Right.
going to set that thing on, let it roll. I wish it was that easy, to be honest with you,
That would be nice.
but it has not proved to be that over my career. I don't think your career. I think that sign behind you about sums it up. Keep calm and carry on.
That's why I have it. I say that all the time. It's kind of like, hey, stuff's going to happen. It's like, just remind yourself, keep calm, carry on.
The one thing just on that little thing that I have is two circles and then the football in the middle. On one side, it's what you can control and what's important, and whatever intersects there, that's all you should focus on. And,
Mhm.
and then I just throw your keep calm and carry on in there, and we'll
Yeah.
be in good shape. Well,
Thanks,
this has been awesome, JJ. I mean,
Thanks, Brandon.
I think that I think we've given the listeners a good overview of the different entities and also the intricacies of each one and why you want to think about it from an evolution standpoint, and then all the different angles you actually have to think about it from, because there's just so many. It's like this big puzzle
It
that
really is.
you've got to put together. Well, I like to end, and I gave you the heads up with my 3 HPTs, high percentage tips from J.J. Childers, attorney, estate planning, business entity setup. What would they be, JJ, from you for our listeners?
First of all, I probably say don't put all your eggs in one basket. which that could be applied for a lot of different areas, but don't put all your eggs in one basket when it comes to your overall entity structure. Some people are looking for the one entity that's going to solve all their problems, cure all your ills. What I do is what's called wealth structuring. What that is structuring the use of various legal entities working one with another to give you the most rock solid, ironclad plan available. The next strategy I would say is what I call isolate and insulate. When we say isolate and insulate, what we are talking about is grouping those eggs, for lack of a better term, into multiple baskets. And you isolate those eggs, for our purposes, those assets, those activities, into their own different legal entities so that you can insulate them from the liability associated with the other legal entities and the other assets and the other activities. So that's what the isolate and insulate. And then the final thing that I would say is always start with the end in mind. And the ultimate end is going to be our end here on earth. And that's where, first things first, that's your living trust. Make sure, always focus with the end in mind. Where are you ultimately planning to go as far as with your assets? Where are those assets going to go? That's what's going to drive this whole thing. That's, if I were to say, what is the first step? First step is put your estate plan together. Everything else can be done after that, but that's the very first part of all this, which sounds a little contrary to when we're on a business podcast. Is that, well, guess what? We're taking care of business. First business, our top priority is taking care of our families.
I think you're absolutely right. Those were awesome. Well, thank you so much. I'm probably going to ask you to come back at some point in the future. Maybe we'll do a live Q&A with some folks. We'll give the warning that you're not going to have the definitive answer, but maybe some case studies will help people even understand this deeper. So thank you so much for taking the time today, JJ, to be on here. Really grateful.
Hey, well, thanks so much for having me. It was a pleasure, and I look forward to hopefully doing it again.
Right on. Thanks, JJ.
Thank you.